The dream is simple: $3,500 a month in rising dividend income for life without ever running out of money. I will show you how to achieve that in this video. What I'm going to teach you in the next few minutes will blow your mind. The strategy I'm about to show you is so simple, you'll wonder why financial advisors don't talk about it more often. But listen, don't skip a second of this video. If you miss even one part, you could miss the step that makes the whole thing work. Let's talk about the elephant in the room. Traditional retirement advice is broken. The old model says, save as much as you can, hope it's enough, then sell off your investments slowly and pray you don't outlive your money. But here's the flaw. If you're constantly selling assets, what happens during a market crash? You're forced to sell at a loss. That's not a retirement plan. That's gambling with your future. And that fear leads to a sad reality. Most people either retire later than they wanted, spend less than they could, or never retire at all. Here's the uncomfortable truth about retirement in the U.S. The average retiree needs between $3,200 and $4,500 per month just to cover basic expenses. That's not living lavishly. That's just paying for housing, healthcare, food, car, and maintaining a modest lifestyle. Now here's where it gets scary. The average Social Security payment is only $1,900 per month. Even if you worked your entire career and maxed out your benefits, you're looking at maybe $2,500. That leaves a gap of anywhere from $700 to $200 every single month that you need to fund yourself. But dividends change the game. They're not just bonus cash. They're the foundation of a retirement strategy built on sustainability and freedom. Let's say you own 1,000 shares of a dividend ETF that pays $2 per share annually. That's $2,000 a year, without selling anything. And next year, that dividend might go up to $2.10 or $2.20 per share. This is what makes dividend strategies so powerful. It's an income that doesn't rely on selling shares. It's a natural hedge against inflation through dividend growth and psychological peace because you're getting paid even in downturns. All right, let me introduce you to the two most powerful retirement tools that Wall Street hopes you never figure out: SCHD and VTI. I will tell you the reason these two combinations are the most powerful. Let's start with SCHD. This isn't just another dividend ETF. This is a hand-picked portfolio of America's highest quality and battle-tested companies. The kind of businesses that don't just pay dividends, they grow them year after year. And here's what makes SCHD stand out. It's dirt cheap to own. With an expense ratio of just 0.06%, you're paying only $6 a year for every $10,000 invested. That's practically nothing, and that means more money stays in your pocket, compounding for your future. Lately, I've been seeing a flood of investment articles and YouTubers praising SCHD like it's the only ETF that matters. Don't get me wrong, SCHD is solid. But let me be clear, you can't build your entire financial future on just SCHD alone. And here's why. The truth is, SCHD is great for income and stability, but it's not the full picture. That's where VTI comes in. VTI is the Vanguard Total Stock Market ETF, and it does exactly what it sounds like. It gives you exposure to every publicly traded company in the U.S., from the giants like Apple and Tesla, all the way down to small-cap innovators that could become the next big thing. While SCHD focuses on dividend growth and value, VTI brings in the growth engines, the high-flying tech, the disruptors, and the long-term compounders. In other words, SCHD gives you reliable cash flow, while VTI gives you long-term growth. The combination of these two is what makes the $3,500 a month dream not just possible, but sustainable, rising, and ridiculously simple to execute. Together, they form a strategy that gives you steady dividend income, long-term growth, and peace of mind for life. Here is a small secret I want you to know. The real magic is in SCHD's dividend track record. Since its inception, this fund has grown its dividend payments by an average of 7.5% every single year. That means if you're collecting $1,000 in dividends this year, next year it could be $1,075 or $1,156 the year after that. Your income keeps growing even if you never invest another penny. VTI has an even lower expense ratio at just 0.03%. That's $3 per year for every $10,000 invested. While its current dividend yield is lower than SCHD, it gives you exposure to the entire U.S. economy, including all the high-growth companies that drive long-term wealth creation. Wall Street doesn't talk about this because it's simple, cheap, and doesn't make them money in fees. But for everyday investors like you, SCHD and VTI are one of the most powerful combos you can build a future on, especially if you want that $3,500 a month goal to actually become reality. Now let's discuss the mathematics of $3,500 monthly income. To generate a $3,500 free monthly dividend income or $42,000 per year, you need to understand how dividend investing works differently from traditional retirement strategies. The old school approach tells you to save up $1,050,000 and withdraw 4% each year. But here's the problem. You're constantly selling shares to fund your lifestyle. In a bad market year, you might have to sell when your investments are down, locking in losses forever. The strategy here is smarter. Instead of relying on selling shares, you build a portfolio that generates the income you need through dividends alone. This means you can ride out market downturns without touching your principal, and your income actually grows over time. Let me show you the best 3 strategies that will help you achieve $3,500 per month from dividends without having to worry whether the market is up or down. With these strategies, you can generate more dividend income monthly. Strategy number 1, the conservative approach. This means allocating 60% to SCHD and 40% to VTI. With a higher allocation to SCHD, you get a solid starting yield and stable income. It's designed for people who want more certainty and less volatility. Strategy number 2, the moderate approach. This strategy involves allocating 50% to SCHD and 50% to VTI. It's a balanced mix of growth and income. If you're looking to retire in your 40s or 50s, this might be the perfect fit. It gives you cash flow today while growing your wealth for tomorrow. It's a strategy designed for flexibility and the sweet spot for many. Strategy number 3, the growth approach. This strategy involves allocating 40% to SCHD and 60% to VTI. This one leans more into VTI's total market exposure. The yield is slightly lower up front, but the capital appreciation can be much higher over time. It's ideal for younger investors with decades ahead of them. Think of it like planting seeds. You water them now and harvest bigger dividends later. Let me show you something most people completely overlook. Time is your biggest enemy when it comes to investing. Someone who starts investing in their 20s might only need to invest a few $100s per month to reach a meaningful passive income goal. But someone who waits until 40 could need 3 to 5 times more every month just to catch up. Why? Because compounding doesn't care about your excuses. It rewards action and punishes delay. Each year you wait, the amount you need to contribute increases significantly. That's why the best day to start was yesterday. The second best day is today. Here's the most exciting part. With dividend growth, your income doesn't stop growing just because you retired. SCHD, for example, has grown its dividend from $1.24 per share in 2013 to over $2.20 in 2024. That's a 7.5% average growth rate. That means your $3,500 a month could turn into $7,000 a month in 10 to 15 years just by holding and reinvesting. No extra work, no added risk, just time doing what it does best. Now let's get tactical. Here's how to structure your investments for maximum efficiency and minimum tax burden. Step 1. Max out tax-advantaged accounts. Start with your employer-sponsored plan like a 401k or 403b. In 2025, you can contribute up to $23,000. With employer matching and profit sharing, the total cap is $70,000. But if you're over 50, add $7,500 in catch-up contributions. Step 2. Contribute to a Roth IRA. The limit is $7,000 annually, or $8,000 if you're 50 plus. All growth is tax-free, and withdrawals in retirement are also tax-free. That's income you'll never owe the IRS a dime on. Step 4. Automate everything you can. Set up automatic transfers from your checking account to your investment account, and automatic purchases of your chosen allocation. This removes emotion from the equation and ensures you're consistently investing regardless of market conditions. For rebalancing, keep it simple. Check your allocation quarterly and add new money to whichever fund is underweight. Only rebalance by selling if your allocation drifts more than 10% from your target. During the accumulation phase, reinvest all dividends to maximize compound growth. The biggest mistakes I see investors make is trying to time the market, chasing hot sectors, panic selling during downturns, and starting too late. Remember, time in the market beats timing the market. Every market crash in history has been followed by a recovery that reached new highs. Your job is to stay consistent and let compound interest work its magic. To succeed in investing, dollar cost averaging is your best friend. By investing the same amount every month, you automatically buy more shares when prices are low and fewer when prices are high. This smooths out market volatility and removes the emotional stress of trying to pick the perfect entry point. Now, let's get to the part you've been waiting for. Exactly how to earn $3,500 per month from dividends using SCHD and VTI, and how much you need to invest to get there. It's a common goal, and I'm going to break it down so it makes sense. For many, that's enough to live a comfortable, modest retirement, or at least seriously boost whatever other income you have. Okay, now picking your investing strategy. Let's look at 3 ways to combine SCHD and VTI and watch the magic happens. Number 1. The play it safe strategy. 60% SCHD and 40% VTI. What it means? You're leaning toward reliability. You want consistent dividend checks you can count on, even if it means sacrificing some long-term upside. Your blended yield is roughly 2.8%. To start receiving $3,500 monthly, you'd need to invest about $1.5 million. Don't freak out. I will show you how to make it happen. This is the strategy for people who want to sleep well at night. Number 2. The just right strategy. 50% SCHD and 50% VTI. This is for you if you're looking for balance between enjoying life now and building a better future. What it means is, you don't want to miss out on growth, but you still want that steady dividend income flowing in. Blended yield drops slightly to 2.6%. Investment needed to earn $3,500 per month is about $1,615,000. It's a sweet spot that gives you both income security and long-term compounding. This strategy is for people who want to grow without being reckless, who are thinking smart, long-term, and playing both sides of the game. But there's a way to make this achievable even if you don't have $1.615 million available to invest. Continue watching. Number 3. The Go for Growth strategy. 40% SCHD and 60% VTI. This one is for the builders, dreamers, and long-term thinkers, the ones who believe their best days are ahead. What it means is that you're playing the long game. You're okay with a bit less income now because you believe your investments will grow into something massive. The blended yield is around 2.4%. Investment needed to achieve $3,500 with this strategy is about $1.75 million. Ever wondered how much you really need to set aside each month to hit these goals? I've been digging into this, and it all boils down to when you start. Let's break down the monthly investment you'd need, based on your age, to reach those targets by retirement, assuming a 7% average annual return. Starting at age 35, 30 years left. For Play It Safe strategy, the amount you need to invest per month to hit $3,500 in monthly dividends by retirement is $1,280 per month. Over 30 years, this grows into about $1.56 million thanks to compound interest. 4. Just Right strategy. The amount you need to invest per month to hit $3,500 per month is $1,365 per month. In 30 years, this builds up to around $1.67 million, combining income and growth. 4. Growth strategy. To reach the same $3,500 per month goal with a more growth-focused approach, you'd need to invest $1,450 per month. After 30 years, this becomes roughly $1.77 million, prioritizing future upside over immediate income. Starting at age 45, 20 years left. At this point, the lift gets significantly heavier. Time truly becomes a premium. For Play It Safe strategy, you're now looking at a substantial $2,850 a month. For Just Right strategy, this would be around $3,075 per month. For Go for Growth strategy, you'd need to put in $3,300 per month. Starting at age 50, 15 years left. If you're starting later in the game, the urgency and the numbers really ramp up. For Play It Safe strategy, you'd need a serious commitment of $4,200 per month. For Just the Right strategy, this target would require around $4,550 per month. For Go for Growth strategy, you're looking at $4,900 a month. Final insight: time is your greatest asset. It's pretty clear, isn't it? The earlier you start, the less you need to invest each month. Seriously, every year you delay, the heavier that monthly investment lift becomes. That's why those early years truly matter. Let's create your specific action plan to implement this strategy starting today. First, calculate your exact numbers using the formulas I've provided. Determine which allocation strategy fits your risk tolerance. Then figure out how much you need to invest monthly to reach your goals. This week, open the appropriate investment accounts if you don't already have them. Most brokers offer commission-free ETF trading, so you can implement this strategy at virtually any major firm. Set up automatic transfers from your bank account to ensure consistent investing. Make your first investment, even if it's small. The key is to start the habit and let compound interest begin working for you. You can always increase your contributions as your income grows. Establish a monthly routine. Review your account balances, ensure your automatic investments occurred, and check if any rebalancing is needed. Celebrate your progress. Every month you're consistent brings you closer to financial independence. Annually, increase your investment amounts along with salary growth. Review your allocation if life circumstances change significantly. In taxable accounts, consider tax loss harvesting to minimize taxes. Keep your beneficiaries and estate planning updated. When a market crash happens, and they will, remember your emergency response plan. Do not panic sell. Continue your regular investments because you're literally buying shares on sale. If possible, consider increasing your investments during major market downturns. Remember that every crash in history has been followed by recovery and new highs. If you experience job loss or income reduction, reduce your investment amounts temporarily, but don't stop completely if at all possible. Use your emergency fund rather than touching retirement investments. Resume full investing as soon as your income stabilizes. Celebrate your success milestones. Your first $10,000 invested. Your first $100,000 where compound interest really accelerates. Your first $500,000, which puts you halfway to most goals, and finally crossing $1 million where financial independence becomes clearly visible. Let me recap what I've covered today. Using just two simple ETFs, SCHD and VTI, you now have a clear roadmap to generate $3,500 in monthly retirement income. This isn't a get-rich-quick scheme or some complex strategy that requires constant monitoring. It's a proven approach based on the fundamental principle that high-quality companies pay dividends, and those dividends grow over time. You've learned that the key isn't just accumulating a large balance and hoping it lasts. It's building a portfolio that generates growing income without requiring you to sell shares. You've seen the exact numbers for different allocation strategies and time horizons. You understand how to implement this strategy in tax-advantaged and taxable accounts. The real secret to success isn't complexity, it's consistency. Time in the market beats timing the market. Starting today beats starting tomorrow every single time. The compound interest you earn over the next 20 to 30 years will be so much bigger and more impactful than any individual investment decision you make. Here's what I want you to do right now. Go watch the video above where I explain in detail the only 3 ETF portfolio designed to make you insanely wealthy. Also watch the video where I revealed in detail what a $5,000 dividend portfolio will pay you monthly. Share your age and the strategy you're choosing in the comments section. And if you have any questions or concerns, don't hesitate to ask me in the comments section. See you in the next one.